Picture this. You're sitting at your computer, ready to invest in dividend ETFs. You've done your research, you've read the forums, and everyone keeps telling you the same thing. Monthly dividend payments are better because you get to reinvest more frequently. More payments equals more compounding equals more wealth, right? Well, what if I told you that payment frequency matters less than 0.5% over 20 years? What if the thing everyone obsesses over is actually the least important factor in your dividend investing success? Today, I'm breaking down the math with verified 2025 data to show you what actually drives dividend returns. And by the end of this video, you'll know exactly which strategy fits your financial situation. Let's dive in. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. So let's talk about the great dividend frequency debate. In the investing world, you've got three main options. Monthly dividend ETFs that pay you 12 times a year, quarterly dividend ETFs that pay 4 times annually, and the rare annual payers that distribute once a year. Now, monthly dividends have this massive psychological appeal. There's something satisfying about seeing money hit your account every single month. It feels like a paycheck. It helps with budgeting. It creates this sense of momentum. And the conventional wisdom says more frequent payments mean more opportunities to reinvest, which should compound faster. But here's where things get really interesting. Let me show you the actual math. Take $10,000 invested at 5% annual yield for 20 years with automatic dividend reinvestment. If you compound monthly, you end up with $27,126. Quarterly compounding gives you $27,015, and annual compounding leaves you with $26,533. Now look at that difference between monthly and quarterly. It's $111 after 20 years of investing. That's a 0.4% advantage. Think about that. We've been obsessing over payment frequency, and it makes less than 0.5% difference over 2 decades. The math is crystal clear. Payment frequency is not the driver of wealth. So if frequency doesn't matter, what does? Let me introduce you to the 2 heavyweight champions of the dividend ETF world. In the monthly corner, we have JEPI. In the quarterly corner, SCHD. These 2 funds represent completely different philosophies, but here's the plot twist that nobody's talking about. Both are currently showing positive dividend growth. Let's start with JEPI, the monthly income machine. As of November 2025, JEPI is yielding 8.15%. That's massive. It pays $4.72 per share annually, distributed monthly. And here's what shocked me when I verified the data. JEPI's dividend grew 11.35% over the last 12 months. This fund uses a covered call strategy, selling call options on large-cap U.S. stocks to generate premium income. That strategy delivered 4.1% year-to-date returns in 2025, with lower volatility than the broader market. The expense ratio is 0.35%. Now that might sound high, but hold that thought. Now let's talk about SCHD, the quarterly growth engine. This fund yields 3.77% as of September 2025. Much lower than JEPI, right? But watch what happens when we look at growth rates. SCHD's 5-year dividend compound annual growth rate is 12.99%. Its 10-year rate is 11.1%. This fund doesn't chase yield, it screens for quality. About 100 stocks that have consistently raised dividends, demonstrate strong cash flow, and pass rigorous financial health metrics. The result? Over the past decade, SCHD delivered 12.66% annualized returns. Its expense ratio? Just 0.06%, 1/6 of JEPI's cost. Both funds are growing their dividends. Both have legitimate strategies. So why does one win for most investors? Let's follow the money. Here's where dividend growth rates become the ultimate wealth multiplier. Imagine you structure your portfolio to generate $10,000 in annual dividend income. Let's project this forward for both funds using their verified growth rates. After year 1, you're nearly tied. JEPI's 11.35% growth gives you $11,135. SCHD's 12.99% growth delivers $11,299, a difference of $164, barely noticeable. But compounding is a marathon, not a sprint. By year 5, looking at cumulative dividends received, JEPI has paid you $69,831 total. SCHD has paid $73,206. Now we're talking about a $3,000 gap. Fast forward to year 10, JEPI's cumulative payout hits $189,367. SCHD's total, $208,024. That's nearly $19,000 more in your pocket from just a 1.64% difference in annual growth rates. This is the power that everyone overlooks while obsessing over payment frequency. But we're just getting started. Let me show you the silent wealth killer that nobody warns you about. Taxes. Under current 2025 U.S. tax law, not all dividends are created equal. SCHD primarily generates qualified dividends. These are taxed at preferential capital gains rates of 0, 15, or 20% depending on your income bracket. JEPI, because of its covered call strategy, generates mostly ordinary income dividends. These get taxed at your regular income tax rate, which ranges from 10 to 37%. Let's make this real with an example. You're a single filer earning $100,000 per year, putting you in the 24% tax bracket. You receive $7,000 in annual dividends. If those dividends come from SCHD, they're qualified, taxed at 15%. Your tax bill? $1,050. If those same dividends come from JEPI, they're ordinary income, taxed at 24%. Your tax bill, $1,680. That's a $630 difference every single year that goes to Uncle Sam instead of staying in your account. Multiply that by 30 years of investing. You've just handed the IRS nearly $19,000 in unnecessary taxes. Payment frequency didn't cost you that money. Tax treatment did. Now let's talk about expense ratios, because this is where investors lose shocking amounts of wealth without realizing it. SCHD charges 0.06% annually. JEPI charges 0.35%. Some monthly dividend funds like KBWD charge 1.79%. These might seem like tiny differences, but let's run the compound math. Start with $100,000 invested at 7% gross annual returns for 30 years. With SCHD's 0.06% fee, you end up with $748,523. With JEPI's 0.35% fee, you get $689,963. That's $58,560 less. But here's the kicker. With KBWD's 1.79% fee, you're left with just $458,892. You lost $289,631 compared to SCHD. That's almost 3 times your initial investment. Gone. Vanished into fund management fees. High expense ratios are wealth destroyers operating in slow motion. So let me give you the importance hierarchy that will change how you think about dividend investing. Factor number 1, rated 10 out of 10, dividend growth rate and strategy quality. This is your wealth engine. A fund that grows its dividend at 13% versus 11% creates massive long-term differences. Factor number 2, rated 9 out of 10, tax treatment. Qualified versus ordinary income dividends can swing your after-tax returns by thousands of dollars annually. Factor number 3, rated 8 out of 10, expense ratios. Fees compound against you. They're reverse compounding, silently eroding decades of gains. And factor number 4, rated 3 out of 10, payment frequency. It barely moves the needle mathematically. We've been ranking these factors completely backwards. So what's your action plan? If you're a retiree requiring monthly income right now, here's my recommendation. Build a 60-40 blend. Put 60% in quarterly dividend growth ETFs like SCHD and VYM. Put 40% in monthly income ETFs like JEPI and GPQ. This gives you reliable monthly cash flow while maintaining dividend growth and tax efficiency. You get the psychological comfort of regular payments without sacrificing long-term wealth building. If you're a working professional still building wealth, the math is clear. Go 100% into tax-efficient quarterly ETFs like SCHD and VIG. You're not living off dividends yet, so payment frequency is irrelevant. What matters is maximizing long-term wealth accumulation through qualified dividend tax treatment, rock-bottom expense ratios, and sustained dividend growth. Let those dividends reinvest automatically and compound for decades. And if you're a high-income professional earning over $250,000 annually, listen closely. You should focus exclusively on qualified dividend strategies like SCHD and HDV. in your taxable accounts. Add municipal bonds for tax-free income. At your tax bracket, the difference between qualified and ordinary dividends can cost you up to 17% of your dividend amount. That's real money leaving your pocket. Here's the final truth that ties everything together. Choose your dividend ETF strategy based on your life stage and tax situation, not based on how often you get paid. For most investors building wealth in taxable accounts, the superior tax efficiency of qualified dividends, the dramatically lower expense ratios, and the stronger long-term dividend growth rates of quarterly ETFs like SCHD make them the mathematically optimal choice. JEPI serves a purpose for retirees needing substantial current income with lower volatility. But if you're accumulating wealth, SCHD's structure wins on every metric that actually matters. Payment frequency is the least important factor in this decision. Focus on what compounds your wealth: growth rates, tax efficiency, and low fees. Those are the variables that will determine whether you retire comfortably or struggle financially. So which category are you in? Are you building wealth or living off income? Drop a comment below and let me know your strategy. If you want more data-driven investing breakdowns like this, where I cut through the hype and show you the real numbers, hit that subscribe button and turn on notifications. And if this video saved you from making expensive mistakes, drop a like to help other investors find it too. And remember, this analysis uses verified data as of November 2025, but markets change. Always consult with a qualified financial advisor for personalized recommendations. Thanks for watching, and I'll see you in the next one.